War in the Middle East, rising oil and gas prices, upside risk to inflation, and pretty much daily reports or updates on whether peace talks are progressing or not. At a time when markets were already grappling with potentially stretched valuations, uncertainty around artificial intelligence, and growing concerns about private markets, the euro area is facing another test of its resilience. So, how resilient is it? How resilient is the financial system in particular? What happens if this shock lasts longer than expected? That's what we're looking at in today's episode of Euro Matters, the podcast by the European Central Bank, where we unpack the stories, ideas, and decisions shaping Europe's economy. My name is Paul Gordon, and today I'm back in conversation with a regular guest, John Fell, who is the Deputy Director General for Macroprudential Policy and Financial Stability here at the ECB, who has just published the latest Financial Stability Review. And good to have you back on the program.
Thank you. Thanks a lot, Paul, and great to be back.
So let's take a look at the state of Europe at the moment and the state of the world. The last time you joined us, you were saying the euro financial system was relatively resilient. The risks from tariffs and geopolitical conflicts had been successfully contained, as far as we could tell, developing basis. Still looking good?
Good memory. Yeah, that's where we ended last time. We said the system was resilient, and yeah, I mean that continues to be our core assessment. But now we are seeing a situation where this resilience is being tested by not one, but two potentially colliding shocks. So we've got the AI disruption shock. It's a kind of a more slow moving shock. And then we have also an energy shock resulting from tensions in the Middle East. We also have vulnerabilities, and I think this is kind of important. You'll see that we structure our FSO around three main themes, and they're usually around the three main vulnerabilities that we see. And vulnerabilities can persist, they can self-correct, or they can be unraveled. And they can be unraveled if there are shocks, and we have shocks. And we have two, not one. Normally, I think when we've done these podcasts in the past, we were talking about one shock, but now we've got two, and they're also interacting with one another. AI disruption. Just think about the economics of AI. It also depends on the cost of energy. To kind of put all of this together into a single number that readers might be able to, get an overall sense for where we are. We have developed, with the help of AI, a sentiment indicator, and this is based on how readers might typically interpret the tone of what we've written in the Financial Stability Review. And I mean, I have to say that this is one of the most negative readings that we've had in quite some time, in a number of years. It's not quite where it was before the pandemic, but it's markedly higher. I think our overall message this time, and if you were to say it in a sentence, the system is holding up, but it's being confronted with having to absorb a combination of shocks, and these are shocks that it has not yet been tested against. So, in a way, the tectonic plates may be moving.
Okay, so it kind of under assault, if you like, from these. We've talked about perma shocks in the past, but here we are, pretty intense. Sentiment markedly negative, as you say. Let's take a drill down a little bit. Let's take a look at some of these on financial markets. I mean, you mentioned the AI, what some people call a bubble, others, of course, deny it's a bubble. But either way, valuations are high by historical standards, and we did see some repricing of software-related stocks earlier this year. How does the current geopolitical shock fit into this financial markets
so this
situation?
This makes the whole thing rather complex this time. I mean, if you take the AI first, I mean, I think what we would say is that views on AI appear to have flipped. So, we had this concern. I think we talked before about these diagrams of financing relationships between AI firms and the interconnectedness, and the big question was, can this investment ever be paid back? Will those firms generate the revenue that would be needed to pay the investors back? Now it's kind of shifted to is AI already disrupting existing business models? And we've seen, some of the software companies in particular being affected by this change in view. And I mean, if that is true, then you could say, yeah, the likelihood of getting the money back is higher. It's disrupting those business models, software in particular. We saw, repricing and substitution fears at the beginning of the year, and then you've got kind of offsetting forces. You've got kind of the short term and the long term of AI. So the short term is the investing. And then the question: will AI deliver the productivity that everybody is hoping for, and lift growth long term? And I think that's kind of the disrupting business models view would kind of support that longer term optimism view, and I think that's why you get this offsetting impact from the negativity that comes from the war. But then on top, you've got this energy shock. If you just pick an example of how closely AI is related to energy, we hear a lot about data centers. Data centers cannot run without energy. So of course that's going to change the economics of AI. What we're trying to look at is this collision that is taking place. It's taking place through valuations. It's taking place through confidence. It's also taking place through balance sheets. And so. What we're seeing kind of now is that the equity price decline was broad-based. It hit cyclical sectors. But I think where we are now is that it's a kind of a known unknown. But this interaction element of it is new. The AI shock plus energy shock. We don't have experience of it. So right. It leaves a cloud of uncertainty as we head into the future, and of course that has had broader impacts in markets. Okay,
that's so uncharted waters, essentially. Yeah. Another element of this, and this is a particular concern that's been raised in the past, but I believe it's becoming more of a concern, is that a lot of the money that's swirling around all of this is in private markets. How does that affect the situation when you look at financial stability?
So look, one of the questions that we get most often, people look at the size of private credit today and they compare it with subprime 20 years ago, just before the crisis, and ask the question, do we have a subprime 2.0, 2.0 situation? To be very clear on this, we don't think so, but we do think that there are a number of issues that give rise to concern. One of them is data gaps. The opacity of the sector, because it's private, you don't have that disclosure that you would have if these companies were listed on the stock market, say, and then there's also the potential for confidence effect spillovers to related markets, so lower tier credit that is traded in the markets. You could get a read over between them. I think if I was to pick 3 points why private credit is not subprime 2.0. The first is...
Just to interrupt before you go to these first 2 points, for our younger viewers and our younger listeners, subprime, this was the trigger for the global financial crisis, 2008. It was a real major market meltdown.
Yeah, it's
with economic consequences.
You're absolutely right. Yeah. I kind of lost track of the fact that it's like half a career ago, a normal career ago. But when people have done the ex post diagnosis of what went wrong, what were the vulnerabilities that caused that subprime thing to explode in the way that it did, and what's different now? I would point to maybe 3 things. Patient capital is the first. Investor lockups. Investors are locked in more or less for the maturity of the investment. So that limits kind of the fire sale dynamics that you would see if you had short-term funding of long-term assets, which was one of the vulnerabilities that was exposed in subprime. Leverage. It's a lot lower than it was pre-GFC, lower than in structured credit. Actually, private credit is much less leveraged than normal banking activity. You can get as lowly leveraged as 1-to-1. 50% credit, 50% debt. And then the last is the third factor is a bit linked to the first. It's maturity transformation was one of the issues that became prominent. Short-term funding, long-term assets. You don't have this in the private credit story. But Paul, I don't know. You're a communications guy. You know the name of William Randolph Hearst.
Right,
he was. He was the one, I think, who said, "If it bleeds, it leads." And the headlines, FT, Economist, all the financial press that we read. I mean, the headlines focus on the business, the U.S. business development companies, the BDCs, where redemption requests have outrun amounts honoured. We have a chart in the FSR showing that you've got requests made for redemptions by investors and how much they got back, and there's a lot less coming back than was asked for. Now that means, of course, that investors are not getting all their money back, but that also shows the redemption gates are working. They're not failing. Now, there's not enough time to go through all of it now in this, but we have a special feature this time dedicated to the private credit issue, because we kind of expected that readers of FSR would expect. Yeah, it's an issue that has been prominent in the press for some time. What our overall conclusion here is, I mean, to be careful with the language, what we're saying, we don't think it is systemic per se in the euro area. But we do think that there are situations that could arise, unlikely ones, but still plausible ones, where it could become a source of stress for the financial system. But we don't think it's going to affect banks, the core of the financial system, but more the natural investors in the type of assets that are produced by the industry, long-term assets. So that's insurers, pension funds, and so on, that could experience losses. But again, those are financial institutions that don't ordinarily or cannot ordinarily suffer runs.
Okay. So just to sum up in very simple terms there, subprime 1.0, there was unexpected contagion, I guess you would say, from the subprime market through the banks. Do you think that's less likely this time?
Yeah, I mean, I think one of the big things, I mean, we used to talk about too big to fail. There was too interconnected to fail that came out as one of the big lessons out of subprime 1.0. There is interconnection here, but it's not in the same way that it was in the, we had all this credit transfer that took place, and people were asking, where is the credit being transferred to? And then we found out that the banks that were trying to transfer credit, it ended up back on their balance sheets in different forms. So now that risk is being spread more widely in the financial system. And I think one could also say, the regulatory reform was really kind of aimed at moving these risks off the balance sheets and the business models of banks and somewhere else. Non-banks are doing, we don't call this a stress test, but it is a test of the resilience, in a way, of non-bank finance for the first time.
Okay, all right. So we drill down into that aspect of financial stability and the risks are out there. I want to pull out a little bit again, because the other big thing is the war. When I say the war, there are two significant wars going on that affect Europe. I'm talking here about the war against Iran. There's a lot of narrative out there in the media saying, and analysts are saying this as well, why are markets so benign? Why the Strait of Hormuz is closed. Energy prices are soaring. On the day we're speaking now, which is May the 26th, and I say this because things can change every day, we've just seen more attacks by the US on some facilities in Iran. Would you say the market is underpricing the risk, or?
Everything you say is absolutely correct, and I think it's been a puzzle to many. I think, Paul, that we rely quite a bit on market intelligence preparing the financial stability review. And one term that I came back from a recent visit to the US with was a term that is normally used in psychology, cognitive dissonance. And it's this kind of the unusual calm in markets against a background of a lot of surprising developments, let's say. So we've got stretched valuations, low volatility, and it looks like the market is priced for a short war. What cognitive dissonance, by the way, it's this, how can you reconcile two conflicting views or beliefs at the same time. So smokers know that smoking kills. So why do they smoke? Villages stay at the foot of active volcanoes. People know the volcano is going to explode someday, but still you can hold these conflicting beliefs, and it can be rational, especially when you've got binary outcomes. So AI optimism and ceasefire hopes, they're real factors, they're positive. And you've got also the downside points that you mentioned as well. So I think the first point, we don't go into the psychology in so much detail in the episode, but I think what we're saying is that it doesn't necessarily look irrational, but high valuations plus compressed risk premia plus very low volatility is a classic underpricing configuration, and it does leave markets vulnerable to shocks. So I think we can be confident on that point. Volatility does look a bit low, and and that's everything else, given what's happening in the world right now.
So these are a lot of the risks that are out there.
Yeah.
Euro area banks obviously are striving to, and we expect them to strive to, build a resilience against this. But there are still going to be vulnerabilities, and part of the job of the FSR is to point those out. So what have you been looking at?
So first point, banks are not the weak point today. I mean, that I think is something, and we said it last time, and that's where you started. The resilience of the banks is something that does bring a big positive element to the overall financial stability assessment. But banks are exposed to nearly every channel that we've discussed, through the energy shock, AI, maybe long-term exposure to private credit and so on. Why do we say banks are resilient? I mean, if you just look at the numbers. I mean, just maybe three numbers. ROE, return on equity, is around 10%. It's been there for a while. Core equity tier 1 is at a record high. NPLs are 2.2%, which is like more or less historical lows. And then in addition, in every banking union country now, we have releasable capital buffers. We did not have that when the pandemic came and shocked us all. On the energy vulnerabilities, and I think, and exposures to the Middle East more generally, and I think direct exposures of banks are very small here. So what we're really saying is that it's the second round, so-called what macroeconomists call the second round channels. The macro impacts the energy, trade-sensitive firms, small, medium-sized enterprises that are energy reliant, and there's also the interlinkage between the non-bank financial institution sector and banks through funding linkages. So banks are net debtors to the non-bank sector, so they borrow short term. In a stressful situation, I mean, you could write a narrative for a stress test around a liquidity squeeze coming from NBFIs that stop funding banks, working through overnight deposits, repo market, and so on. That could be a potential source of stress. But I mean, overall, I mean, we think banks are resilient, but we need to watch. We need to watch these links to the vulnerabilities that we're highlighting in this issue of the FSR.
So, correct me if I'm wrong, but a sort of a takeaway from this is that the shocks are serious. The risks are very weighty. The resilience is to a large extent there for the financial system. But overall, are you calling for new policies, improved policies? Does more need to be done here?
I think my answer to that is echoing a bit the advice that we would give to sovereigns. I think it applies equally to macroprudential authorities. Familiar policy messages, but the urgency has changed. So the messages that we have this time for banks are things like maintain releasable capital buffers. We have that. This is not a time for releasing. Keep borrower-based measures, things like loan-to-value ratios, debt service-to-income ratios, and so on. Keep them in place, and also we have this initiative for simplifying supervision, but our view is that supervision is fine to simplify, but do it without diluting resilience. And then for non-banks, it's all about implementing agreements that have already been made on leveraged liquidity reforms, build an EU macroprudential framework, and maybe one of the new ones that we've added this time is close data gaps, especially on private credit, to assess exactly what the implications would be of a full-blown private credit stress. It can't be done without more complete data. And then I think the last thing, and this is becoming more and more important, and I've been involved with the Financial Integration Report this time as well, and it's all about advancing the Savings and Investments Union. And financial stability and a solid macroprudential framework, I think, can make Europe attractive for a successful Savings and Investments Union. So, 3 pillars: resilient banks, non-bank reform framework, and deeper EU capital markets.
Okay, all right. It's for anyone out there who wants more information on financial stability, all the materials about our so-called FSR that comes out twice a year are on the website, of course, so have a look at those. There's some good stuff, including, and John's too modest to mention it, but an article in there by John himself on the housing market. John, thank you very much indeed, but we're not done because it's hot tip time. What have you got for us?
So, there isn't a space every time in the FSR to cover, all topics that everybody is interested in. So I thought an unrelated topic, one that we are looking at, and we've discussed before, is the whole issue of blockchain, crypto. So I'd like to make a book recommendation. It's called The Blockchain Scholars Book, Current Academic Insights Condensed for Busy Practitioners. And it's edited by Daniel Liebau and Simon Trimborn. Why read it? It's got wide coverage. It covers issues from tokenomics to stablecoins to CBDC. Articles are short. There are a few pages each, designed for busy readers. And I think one of the key points is that the articles are written by academics, but they are not written for academics to read. They're written for practitioners to read. So it's informed by the leading academics in this area, and you can read one of the articles in less than half an hour.
Okay.
Hard to beat.
Yeah. Wonderful. Thank you very much, Steve. Great tip. John Fell, Deputy Director General for Macroprudential Financial Stability here at the ECB, which brings us to the end of this episode. You've been listening to Euro Matters with me, Paul Gordon. Of course, if you like what you've heard, subscribe to the podcast. Wherever you're listening, do leave us a review. We're always open to improvements. And in the spirit of Europe, I'd like to end in Irish and say, Slán go fóill. Until next time, thanks for listening.